our next panel, how regulation can support the path to net zero. This is going to be a panel, like all the others, where you can ask questions, but the questions will be moderated by our moderator, our panel moderator, and that is same as last before lunch. Sylvia, please, I'm going to give you the floor, and you can introduce the panel. Thanks very much.
Thank you so much. It's good to be back. So we started talking about policy and regulation in the previous panel, and then judging by the comments that a few of you submitted in the Q&A, through the Q&A app, there was some pushback, right, against policy. I mean, so is it just policy? Should the companies do more? But actually, quite a lot of it, I would argue, and maybe you would expect that from me, given that I cover this day in, day out for sustainable views. A lot of this, really, a lot of this area, a lot of the world of sustainability and ESG, and then we will continue actually talking about a lot of this, the big and ever-expanding alphabet soup that describes this area, is driven by regulation. So in this panel, we're actually going to talk a little bit more and really dive deeper into what regulation is looking at the moment when addressing climate change, but also sustainability concerns. And to do that, let me introduce you to our panelists. So we have at my far right, Lucrezia Reiklin, who is a professor of economics here at the LBS. Next to her, we have Emily McKenzie, who is technical director at the Task Force on Nature-Related Financial Disclosures. And right next to me is Marcel Aubert, who is assistant professor of accounting. So he can really give us some very detailed, interesting aspects of this here at LBS. And joining us remotely is Javier Echave. Hi, Javier, who is the CFO of Heathrow Airport, and I can see you're back there at Baggage Reclaim. So welcome everyone. So regulation, right? The first thing to address is the language of sustainability and the language of regulation, because this is becoming a very confusing subject to address, not least because of the terminology that we are ending up using. So from ESG, environmental, social, and governance, and arguably already it's a pretty clumsy, not particularly attractive, and some might say meaningless term, to other abbreviations such as CSRD, SFDR, ESRS, ISSB, and many other TNFD as well. So ISSB is the initiative of the International Accounting Standard Setter, IFRS, and it looks at creating a global baseline for the way in which companies disclose information around sustainability, which can help understand what companies do in the same way that we, mostly investors, but also other stakeholders, are now able to understand what they do from a financial perspective. So Lucrezia, let me start with you. You've been very active in the developments of the work of the ISSB. Why don't you take us through how you feel the language that is underpinning sustainability through the work that you're doing is developing?
Okay, thank you, Sylvia, and it's very nice to be here with a lot of people interested in sustainability. That's good. So for transparency, let me say I'm a professor of economics. That's my main job, but I'm also a trustee of the IFRS, which is the International Foundation for Reporting Standards. And I think the IFRS is the global standard setter for financial accounts. So think what the financial system would be like if we did not have standards for financial accounts. So how would company, read performance of companies around the world, how investor would, read this information if we did not have global standards which are auditable, assurable, and so on. So now the world is changing. There are new risks, new opportunities, and the climate risk is huge, as has been discussed. It's not the only risk. We have risk related to depletion of nature. We have risks which are related to social, and so on. But these risks and opportunities have to be taken in consideration by companies. Investors want to know this information. So we need standards. We need to achieve in sustainability what 20, 30 years ago had been achieved for financial accounting, okay? So the IFRS, after a consultation with stakeholders, companies, and regulators, asked, do we need these standards? And actually, in the last 20 years, a lot of organizations like the SASB, the Integration Reporting Foundation, a lot of these organizations actually formulated some standards and these are private organizations which were followed by companies on a voluntary basis. But in a way, so we started this consultation in 2020 from a situation in which there were lots of standards, lots of initiatives, lots of different acronyms, and that was called, in fact, the alphabet soup. And so in our consultation, we asked, do we need to harmonize? And do we need to aggregate these different initiatives? And should we do it as financial accounting standard setters, the IFRS? And actually, the result of the consultation was yes, yes, yes. And so then, I led that task force that actually, eventually formed the SSB. And I think it was a fascinating work because it was the result of a combination of a bottom-up process, so something that aggregating from something that was actually already there in the market, and a top-up process because in order to be an aggregator of those initiatives, we needed to have the support of the global financial regulators, which we got. And so the support of the IOSCO, the market regulators, the G7, the G20, and so on. And so, in 2021 at COP26, we established the SSB. Now, Emmanuel Faber, that the CEO of Danone that Julian talked about, is now the chair of the SSB. So, and then, the standards are out. So, and they've been out after consultation. So they're going to start kicking in from 2024. And these are standards for the global market, okay? That's a very key thing, so that we are a global standard setters. Why? Because the capital market is global, and so we need standards that work in China, work in Africa, work in Europe, and work in the US. This is not easy because legal frameworks and public policy tools are very segmented. So, but we need a global regulator, okay? And so we came out with this idea of the global baseline. So we, we have a concept which we ask companies to disclose standards which are financially material, and then maybe we can discuss later what that means. And then if there are jurisdictions which are more ambitious that you want to standards because they want to achieve the Green Deal, like, for example, Europe, they have a top-up, okay? But the important thing is that there is a coherence between these different levels of disclosure so that the preparers and the accountants don't get crazy, okay? Basically, we need something which is relatively easy and transparent and understandable, or otherwise there would be a backlash.
Yeah, perfect. Okay, so this is the ISSB. And how many, obviously I can't see the hands if they would ever go up, back where you're looking at us from your offices or homes, but here, how many of you are familiar with, for example, the ISSB or the TNS? A few hands, okay, good, wonderful.
My students, of course.
All your students, yes, I'm students. Wow, you've been warned. Very important and relevant initiative. Emily, why the need to have another global initiative that looks, in this case, at nature, so on the back of another similar task force that we're looking specifically at climate-related financial factors? Why nature, and how does your work gel with the ISSB and any others?
Yes, there's increasing recognition from governments, from regulators, from central banks and supervisors, from investors, and from companies, businesses themselves, that nature more broadly than just climate change, we are experiencing historically unprecedented loss of nature and its diversity. driven by climate change, but driven by other things also, is creating material risks and also presents opportunities. Important milestones have happened. In December last year, we had the Paris Moment for Nature, where nearly 200 governments agreed to a set of global goals and targets to halt and reverse nature loss, so recognizing this as a global issue. The Network for Greening the Financial System, which is a network of over 100 central banks and supervisors, also recognized that nature loss creates macroeconomic consequences and risks to financial stability, so is core to the mandate of central banks and supervisors. And we have a growing number of investors, for example, BlackRock, Aviva, others who, August Bank Investment Management, which is the biggest sovereign wealth fund in the world, who are also recognizing that their portfolios are exposed to these risks. And then you have large corporates who are actually at the front line of seeing pollinator collapse or water supply issues or failure to be able to get permits because of the impacts that they're having. A variety of physical risks as well as transition risks apply to nature as a whole. And in many ways, we've made tremendous traction through thinking about climate change and climate mitigation, but ultimately, we're under one planet. It has a number of Earth systems. We know from the Stockholm Resilience Center that actually 6 of those 9, if you think of them as Earth system boundaries, are outside of their safe space. Climate is just one of 6. So in many ways, we're just drawing, it's like an entry point into seeing the risks more broadly. So that's all backdrop for why nature. I think a very clear argument for why this is presenting implications for society at large, but also for business and for finance. So why another initiative? Because there was another initiative with another 4-letter acronym that has, I think, been hugely successful in creating momentum around climate. That was the Task Force on Climate-Related Financial Disclosures, TCFD, which created a set of recommendations back in 2017, which were around disclosure, but also around risk management for these issues around climate. And it's had huge, huge implications, I think, not only for disclosure and for disclosure for investors, but also for improving strategy, governance, and risk management, improving decision-making and capital allocation. So we, TNFD, saw that success and also realized that climate and nature are tightly interlinked. You can't really think about climate risks and opportunities without thinking about nature, because we know 30% of climate risks are driven by nature, and climate is one of the biggest drivers of nature loss. So we thought we'd build on the same model, the same process. We established a market-led task force. So we're certainly not regulation, and we're not a standard. Yep. We're a set of market-led recommendations, because the market is recognizing this as a material issue. And we see the ISSB as an absolutely critical milestone for creating this consistency. It's already consolidated a large number of the alphabet soup. Indeed, TCFD, our sister organization, has just sunsetted and declared success because their recommendations are now folded into the climate standard S2 that ISSB has launched. So we hope one day also to sunset.
TCFD is part of the
TCFD is part of ISSB. It is folded in, and they have declared success since 2017 with ISSB's momentum. So we stand ready to support ISSB as and when they have, they've completed their agenda consultation process, see where nature is a priority, stand ready. We've worked very hard to create the consistency with the standards so that we'll make it as easy as possible to dock in. So I think generally I see the path of recognizing these issues, having the momentum to make progress, which sometimes needs a 4-letter acronym. Yep. But then over time, ISSB has created this really important platform for that consistency for the baseline. Yeah. And we've been quite thoughtful about how we can then enable that top up. So the European jurisdiction is helpful for us because they've already gone further. So how can we make sure our framework can not only help to meet the ISSB's baseline, but help sort of 10,000 or more companies in Europe who also need to disclose on their impacts regardless of financial materiality.
Perfect. So the ISSB is serving also as an umbrella for other existing or pre-existing reporting standards such as SASB we mentioned, and also incorporated some of the principles under TCFD. And what you're doing essentially is also helping companies with their strategy, right? So internally they become more aware of the importance and the impacts of nature and nature loss on their activities. And again, as you know, there are many other reporting frameworks and standards that have been developed over the years. Lots more to come. And Marcel, coming to you now, have any of these actually helped?
Well, I'm obviously not in a position to give a perfect answer to that or any answer to that, but I'd like to take one step back and help us think a little bit about the usefulness of all of this. I think Lucrezia and Emily have given fantastic overviews of where we are, really in the practical weeds. One step back, something we academics care about, what's the theory behind that, and why do we do that? Does that make sense? And to also give you some insights into what do we do as professors at LBS and with many colleagues all around the world. It's thinking about, is disclosure regulation, a powerful part of overall climate regulation that can help us get to a net zero, and that's why we're here. So one could ask the question, why do that? And Lucrezia has given a very practical argument. Capital markets need this information, of course, so why not say, okay, let's disclose as much as we can. It's not straightforward how to do that. Well, the reason is that disclosure can also create costs for companies. And I think Javier will confirm that compliance costs, somebody has to report and file these reports, that's why we have so many accountants in the world, maybe, but also all sorts of other proprietary costs. For example, your competitors see exactly what you do. So it's not straightforward that full disclosure and full transparency is always the perfect solution. I guess the main idea here behind climate-related disclosures, to be a bit more narrow, and the ISSP is that, well, to help investors, but also induce certain behaviors of companies in the sense that, like, sunlight is the best disinfectant. So if we disclose things, have companies become transparent, then we can measure things. And as we also say at business schools, only what's measured can be managed. So the key question, I would like to give a brief overview of what we know. Does this work? Disclosure in general, does this work? And we have a bunch of studies. I think Alex Edmonds would say some of those are more rigorous than others, but they paint a consistent picture, meaning that if we mandate companies to disclose about their sustainability activities and environmental outcomes more narrowly, then they reduce, apparently, their dirty behavior, their pollution. Effect sizes here have been documented to be relatively large, 10 to 25%. I don't know whether a CFO like Javier would believe that companies reduce emissions by 10 to 20% because they have to disclose. So it seems to work, so it can be a powerful tool. A caveat, of course, these have been effects found at the margin for firms just being pushed into this sort of mandatory disclosure regime, like in the UK since 2013. My students will know UK companies have to report on greenhouse gas emissions, and those affected firms apparently reduced emissions by 8 to 10% relative to European peer firms. However, only in the first and second year, so this effect was transitory. So I think it's obviously an important milestone to have globally a consistent disclosure framework, but that's only one aspect of regulation. Yeah. Probably we need more intrusive regulation as well to help get to net zero.
Okay, so emissions have gone down, and of course then also we need to talk about the numbers behind that, right? So this decrease, is it because they actually stopped emitting as much, or is it because they've used some other instruments, such as, for example, carbon offsetting, to reduce those stated emissions? But we'll talk about carbon offsets as well, which I know is one of those really, really hot subjects that usually people like to hear about. Javier, okay, you're the one that actually has to put together this data, disclose it. I'm sure you have plenty of investors and other stakeholders asking you for that data. Tell us how complicated it is to put together a meaningful sustainability report and to look also at the risks that all these factors have on a company such as yours.
Great, thanks, Sylvia, and good afternoon. I'm very sorry for not to be there, but I'm also here in the baggage hall trying to make sure that you're having a successful holiday for some of you that might be tempted to go out this weekend. So, and I think in terms of sustainability, well, first of all, I think this is an absolute shift in the way we operate as a business. I think particularly aviation, I think it's a very iconic industry. It's an industry that has this perception that it's hard to abate, and therefore for many years, I think at Heathrow we have been really working on shifting our overall strategy, because I think that becoming a sustainable business is not just a matter of values, it's actually a matter of value and license to operate. I think if we continue creating a conflict between flying and planet, planet should and will win. And therefore, I think the question for us, the way that we are addressing sustainability is very much about how can we protect the benefits of aviation in a world free of carbon. That is ultimately carbon what is killing the planet. I think aviation has has a critical role in terms of delivering at least 9 of the 17 United Nations Sustainable Development Goals. But carbon is definitely something that needs to be removed and needs to be removed at speed. And therefore, urgency, I think, is one of the fundamental things. And I think sometimes when we talked about regulation and reporting, I think one of the important things that we shouldn't forget the goal of all of that. I think we ended up where we ended up today in terms of the impact on planet because over 2 centuries we have been optimizing our economies to a single currency, and that currency is sterling pounds or US dollars. But actually, what we have learned over the last couple of decades is that in the process of optimizing against that currency, we have neglected the consequences it has in terms of creating externalities to the planet. And therefore, what we really need to figure out now is how can we change the reporting? How can we give enough data points to investors to change the way they measure success? Not purely in economic terms, but actually economic terms adjusted by the impact on planet. And that's the fundamental challenge, how we can help investors, which is ultimately the goal of all these IFRS standards, how we can help investors to allocate capital more effectively against a slightly more complicated metric, which is a risk-adjusted, a carbon risk-adjusted economic value. And I completely agree with Lucrecia, and actually it's fantastic that Lucrecia and the other colleagues in IFRS has created the ISSB, because it's in my view, the most powerful, and if there's a single horse to back, that's the ISSB, to really put order when it comes to sustainability standard, because I think we all have a duty to provide data to investors to allocate capital more effectively. I think part of my role as CFO is that I spent a significant part of my time raising funds to fund the terminals that hopefully you enjoy. In my career, I have raised 44 billion pounds of financing globally, and I have seen a huge increase in investors seeking that carbon risk-adjusted value generation. That's why I think it's really important the work that is happening at this stage. Unfortunately, this stage is a bit too complex. There are too many standards, and I think that we all need to keep co-creating this environment where we try to move as fast as possible. Because if there's one thing that we don't have when it comes to sustainability and climate, is we don't have too much time. We're already late, and therefore trying to really converge to a single platform, which I hope, and we are working hard to make that happen, is the ISSB and the IFRS new standards. Part also of my role is I co-chair the European CFO leadership networks in the UK to really on reporting matters, and I think that we are working quite closely with the ISSB to try to make the rules simple, and but also to create a safe space where people can report. I think one of the best news that has happened also, apart from the creation, is also the appointment of the leaders of the ISSB. Emmanuel Faber, Lucrecia mentioned, is a pragmatist. He has been a CFO and a CEO before, so he has suffered the consequences of poor regulation. And I think that one of the great things, one of the great news, is that he's an absolute pragmatist. The same with Sue Lloyd, the vice chair of the ISSB. She has been setting standards for many, many years. And therefore, I think the ISSB is doing a fantastic job, but they need help. And I think that the best way of helping them to create powerful regulation is, rather than complaining, rather than moaning about the regulator, actually the best thing that we can do is to put in practice those standards as fast as possible, so we can find the challenges that those standards unconsciously or inadvertently can create for corporates. So one of the things that we have been doing at Heathrow, but most of the big organizations in the UK are doing, is to take in a voluntary adoption of the standards, voluntary adoption of TCFD, TNFD, because I think that what we really need is collectively to create standards that can be flexible enough to create an environment of trust. Because is the most polluting companies the ones that needs to start disclosing early. For those companies who have a perfect sheet of paper and they are not embarrassed to disclose, they are not going to be the ones really helping to remove carbon from the air or removing or supporting nature. I think are those who are creating the worst impact into that, the ones that needs to save. And that's why I think the ISSB also has done a very good job in terms of creating clear guidance, but again, being guidance, not being too prescriptive to try to avoid people misreporting.
Thank you so much, Javier. So we still have, in theory, 5 minutes to have a little conversation among us, but then I would really like to open the floor to questions which are already coming in. So thank you so much for submitting them. Essentially, reporting is good, right? We all want to have pertinent information available. Too much reporting means that, of course, there is a burden on companies, and all the companies and CFOs I speak to, they have the same reaction that you do, Javier, which came through the videos. This deflation, like, oh, there is too much, too many frameworks, too many requirements, too many standards. So. Number one, good, there is a global effort to bring them together, but of course, there isn't really yet agreement on, I would say, on what is important, the key important things to focus on, because in here we start talking about materiality, what is material to companies, and whether that should be the sole focus of these reporting standards, or whether we should also try to analyze and disclose companies' impact on the environment and on society, which is the point of view of the EU, which has been also very active in its regulatory work and being quite vocal as well about the importance of measuring impact in this sense. Lucrezia, let me come back to you. So how do you see this conflict? Because I think it is a conflict, isn't it, being resolved?
Well, I don't think it's necessarily a conflict. I mean, there are two ways of understanding this problem. First of all, let me define it, okay? So at the FRS, there is a tradition, as standard setter for financial accounts, we have a concept of materiality, okay? So that you disclose, what do you disclose? What is financially material? So what makes a difference for an investor to decide to invest or not to invest in a company, or for capital market, So this is a very, clear concept which has been used for financial account, and and this is the same definition that we use for sustainability. This has certain advantage of transparency, and also it allows to relate sustainability disclosure with financial disclosure, because at the end of the day, maybe in the future, we want to have a fully integrated reporting in which all these risks and opportunities for a company will be fully disclosed. Now, the European Commission comes and says, not only the European Commission, but also the GRI or other organizations around there, they say, no, what we want to know is also what companies do impact on the environment. So we want the other side of materiality. I call that, more impact but they call it double materiality. Now, the second part of materiality, of course, is very difficult to define. So material for whom, material in what sense, material at what horizon. So, it's very difficult to measure. So that's one. But so an institution which has a public policy tool, like for example the European Union, which have the legal framework to impose these standards, they may want to ask companies to disclose what they think is useful for their public policy objectives. Now, as a global regulator, we don't have these tools, because we have to serve a number of jurisdictions which have different legal frameworks and different objectives. So we would not, so that would be, just going beyond what we are, supposed to do and what. So, I mean, and this is how, we define this concept of the global baseline, in which we say we have this base, which is the financial materiality concept. And then if a jurisdiction has other objectives, they can put a double materiality on top of it. And the GRI, which is an organization which is a private sector type of organization, has also developed some standards that the EU is building on. And we are working with the EU and with the GRI to make this interoperable, okay, to provide interoperability. Now, but one thing I want to make sure that everybody understands, that to limit the concept of materiality to financial materiality, that doesn't mean that we do not have to look at also the interaction of what companies do with the environment, because of course, these risks and opportunities are very much, the two things are related. So in fact, in our standards, we ask companies to disclose about CO2 emission, Scope 1, Scope 2, and Scope 3. So we have also these metrics. So now if we look at the standards of the European Commission and our standards on climate, we are very, very similar. And what we are trying to, what we're working on now is trying to make sure that it is clear for the preparers what is ISSB specific, what is EU specific, and where there is the overlap. Yes. Yeah. Now, of course, because on climate transition risks are important, what happened to public policy has an effect on what is financially material. So, this connection is very important for us. So, and so, so it's not that mechanical. Yeah. Okay, that's.
Yeah, thank you. So there are already a couple of questions about the ISSB. So forgive me, I'll have to stay with Lucrezia, but perhaps you also have something to add to those points. So one of them is about, GRI and SASB, are they going to disappear? Potentially, yes. Now
they have already. No, not GRI, SASB has already.
So SASB is part of the ISSB, and GRI, yeah. So that's the direction of travel. And another question is about carbon taxation. So we started talking about carbon pricing, and the person asking the question is asking whether the ISSB could ever become a sort of designer of a globally consistent and integrated carbon tax system.
Carbon tax system. Yes. No, I think it's, the accountants are not going to solve the climate transition problem, okay? So that how much I love the accountants. This is a very complex problem which requires different tools and different policy tools. So the carbon tax is one of these tools. Disclosure is about the information architecture. Yeah. So we need to have the information in order, for capital markets and for public policy. But disclosure, once you disclose, it doesn't mean that you do something, you just disclose it, okay?
Yes. Now, you're not going to see an upgrade of your...
If there is an externality, then you want to have we want to have a carbon tax, and actually it is, of my opinion, that you need more than a carbon tax because you also need investment. And you also, you need public investment, and because, there is not just an externality, but there is also the need to build an infrastructure and also to incentivize technology, which is very risky, and the private market may not necessarily go for risk investment. Yeah. So we have to think about a broad set of tools. Yes. We are just doing a little bit, okay?
Not a job for the ISSB, but the question about carbon pricing and the global price for carbon, meaning either through markets or through tax, is there. Marcel, are we ever going to have a global and high enough carbon price?
Yeah, hopefully, certainly. We're not there. Countries like, I'm going to blame it, Germany, does not have a carbon tax. But there was a blueprint out there, or there is a blueprint out there since 2021, showing how this can actually work. Because as Lucrezia has pointed out, these types of regulations, tax law is jurisdictional. So you need individual jurisdiction, like a country or the EU, to design and impose the tax. So your question is, how can this work at global scale? Because we are addressing a global problem, of course. The blueprint was the global corporate minimum tax. So 2021, many countries, jurisdictions came together at the OECD level as kind of the organizer to agree on the concept of a global corporate minimum tax. And that's now, only 2 years later, being implemented in more than 100 countries worldwide. So this is the way it can work. Companies coming together at events like COP, for example, in principle agree on a design, commit to a certain level, and then introduce it at the domestic or jurisdictional level. So there are processes and blueprints out there, and hopefully this will happen.
Okay, so let me ask Javier, and then I wanted to ask a question to you, Emily. Javier, would you like to see a carbon tax, a global carbon tax?
Well, I think carbon costs money, and I think that you can call it tax or you can call it a price for carbon. I think it's to be honest, if we use an analogy, I think that we saw the case of Bitcoin a few years ago when suddenly there was an exercise to try to measure the whole value of the economy against 21 million units. Of a particular currency, and that's why that set a price for that particular currency. I think with carbon, something similar will happen. I think that in the foreseeable future, we have a limited carbon budget that collectively we can use, and therefore that's going to create a quantification of a carbon unit that today I think is from a shadow perspective is trading, but I think at a certain point it will be more than a shadow market, and therefore that's going to create a price for every carbon unit. So I think that the only thing I would disagree with Lucrezia is that I do believe that accountants will be the ones sorting climate change, and the reason for that is because we are the ones who can quantify what's the cost of these externalities, and once that happens, I personally believe that debt capital markets will play their magic and will create the right incentives to penalize the wrong behaviors and incentivize the right technologies to sort it out. So as a private accountant, I do think that we have a huge role to play.
All right.
Accountants are revolutionary.
Okay, there is certainly a comeback of accountants. Emily, do you have an accounting background as well?
I have an economics background, but I have a love of accounting.
You have a love for accounting, okay.
Yeah, so I am
Wonderful.
also with Javier in the path of I guess, moving from economics to realize the reality of externalities, to then witness the gaps in policy and I mean, all of us taking responsibility for this as both voters and consumers to solve these externalities. And in their absence, I see disclosure as a way of filling these missing markets, addressing them, but it cannot solve all problems. We will still need policy and regulation to play a role. And in the meantime, coming back to your point about what we can only manage what we measure, it is actually increasing this recognition that yes, we have produced capital, we have human capital, we have natural capital. The depletion of that natural capital is something that we need to be accounting for. You can bring this into the accounting system and look at the implications of it in terms of risks and opportunities that will bring all of this to life. So I, like Javier, have great faith in accountants saving the world.
Wonderful. So a few of the questions coming in are about trade-offs, and one in particular is about the trade-off of, for example, reducing emission through means that may have a negative impact on nature. How challenging is it to measure those trade-offs? Are you looking at those? I'm sure you are.
Yes, well, there's a downside in that there are trade-offs. You know, for many different areas where we may be looking at solutions for renewable energy, there may be then the source of minerals for fulfilling that is going to deplete important parts of nature. But there are also upsides in that there are potentially big solutions for climate change through restoration and conservation of, I mean, basically the planet as a carbon sink and a source of sequestration that we can use to solve the problem. So I think, yes, we need to be keenly aware of the trade-offs and we need to be keenly aware of the synergies. And that's where I think the very interesting challenge I was talking to Lucrezia is going to come for the ISSB now, having developed its first standard with a set of general requirements for sustainability overall, and then taking one slice of climate. Now thinking about the interactions of climate and nature, where there may be both synergies and trade-offs, and then of course the important dimension in all of this of people at the heart of this.
Yes.
So, I mean, I think it's and having started, I sort of switch sometimes thinking, why is everybody so limited and only thinking about climate mitigation? Not to be a critique of this day's conference having a focus of that, but in many ways it's an asset in that people have come to think about this one issue and then can use that as a bridge to thinking about others that are connected. But in some ways, it's so tough to solve that one thing. And coming back to the reporting context with Javier, right? One of the reactions we get when presenting TNFD's work would be, another issue. But it's not just another issue. It's an interconnected issue. You cannot solve one without the other. So we are asking a lot of all of us to solve interconnected problems, and that's going to be, a really exciting but challenging part of what will all help ISSB to address.
So to wrap up this session, and given that we're here talking about these subjects ahead of COP, let me ask you all to share just a couple of minutes about what you think will actually come out of COP in terms of regulation. I'm going to start from Javier.
Well, I think hopefully what it will come out of COP is a bit more focus. I think time is the thing that we do not have. I think COP is going to start focusing more in more specific areas, and I genuinely hope that what we get is a bit more focus and simplicity, which is what we really need. I think a carbon out today is much better than a unit of carbon out tomorrow. So I think that I hope that what we get is focus and simplicity.
A simpler system. Marcel, I'm sure you agree with that as well.
Absolutely. I mean, obviously a lot will be focused on the global stock take this year, of course. In terms of regulation and bringing this, tying this together with Javier's ask or demand for focus, I'd hope as an academic that we focus on what we know really works. Transparency and disclosure is very powerful, and we also know that tax policy, either as a carrot, providing incentives for investment, like through the Inflation Reduction Act, or as a stick, carbon taxes, can also provide very powerful incentives for corporations to change behavior. And if we focus on that, I think that would already be a success.
All right, so simplicity and effective ways of changing behavior. Tax. Emily?
I think, once again, there's going to be a strong emphasis at this COP on the connections between nature and climate. So I think increasing awareness and understanding that that is the paradigm we're moving towards and have to move towards. And then I think also just continued momentum. There will be dialogues at COP between the market-led framework developers like ourselves, the standards setters like ISSB, and the regulators like EFRAG to continue on that ongoing dialogue, because we're all moving with urgency fast. But these are complicated things. To create that consistency that everybody's asking for is to create that ongoing dialogue. You have to have very nimbly be sharing things to make sure everything we're doing remains consistent. So I think those conversations will continue.
Consistency. Thank you. Lucrezia.
Yeah, I think that, we have made the first step, which is, we have now a standard setters, at least for climate, and then there will be a discussion about how to go beyond climate. But now the challenge is adoption. And for adoption, you really need a global dialogue. And we don't have a global dialogue. I'm not particularly optimistic about COP. And this is just for what concerns what we have discussed in this panel. But, in general, that we need, according to the IMF, we need about $5 trillion annually of green investment every year from now to 2030. A lot of that will have to be private. A lot of that will have to be coming from emerging markets. And money are not going to emerging markets. So I think that emerging markets is the key issue. And also, to get that money in emerging markets, we need a global dialogue. And also in that, that's is going to be, the main political issues is there.
Of course.
Okay, so that.
Of course. So for a green transition, we also want it to be a just transition that works at policy and government levels, including supporting emerging markets transitioning to a greener economy. And they're, of course, arguably and effectively the most exposed to the effects of climate change. And also, you want to be able to channel private capital towards the companies and the initiatives that are arguably, hopefully, better at tackling this challenge. And so let's hope that accounting will help.
And by the way, if I can advertise, so starting from next week, the Wheeler Institute at London Business School will have 4 lectures on standards and adoption in African countries. And we have a lot of, already demand for this kind of also capability buildings, which I think is very important, where business school can have a role.
And you were saying that there is quite already a high level of take-up, which indicates the interest that there is in this subject. So that's it. Thank you so much for joining this conversation. It's wonderful, and the more you get into the detail, the more interesting it gets, I think. So do keep on following all of the panelists' work in this area. Thank you, Javier, also for joining us all the way from Heathrow, from the floor. And thank you, of course, also to Marcel, to Emily, and to Lucrezia. And for anyone Of course, also wanting perhaps to have a look at the kind of coverage we do at Sustainable Views on policy and regulation, come and check us out at sustainableviews.com. Thank you again so much.